Good afternoon, everyone. Welcome back to the Schwab YouTube coaching channel for our next topic, building a stock portfolio. I am your host, Kevin Horner. I am a senior manager with Schwab Coach, of course. Glad you are all joining us here today. Today we are going to pick up the same conversation we've been carrying this year about building a stock portfolio, doing so in leading groups. And what do we mean by that? Well, leaning into a top-down methodology, starting with a broad market review today. We'll see which ones of the major indices might be providing some leadership opportunity. Then we'll look and evaluate the sectors providing some additional leadership, and we'll drill into those sectors, or at least one of them today, that we don't currently have exposure to in our example portfolio. So we're going to be taking a little bit of a similar but balanced approach to what we try to do in the concept of building a stock portfolio and working with groups that are already leading and trending upward wherever they may be. So not adhering necessarily to stocks that we may be familiar with, stocks we might be very comfortable with, merely because we've learned something about the difference of this market in this year compared to our prior few years. So with that in mind, let's take a minute and say hi to Connie Hill in the chat. Connie is going to be able to manage questions and comments that I'm unable to get to, but we'll certainly keep an eye on things for you there. You can follow us on X. That's a real help to us. Kevin Horner, CS, Connie Hill, CS, and you always want to be sure you're subscribed to the YouTube channel that we call Trader Talks so that you're aware of all we're up to. Remember, you get live content from us Monday through Friday at market open all the way through about 4:45 p.m. Eastern daily. So lots of great opportunity to engage with us. Now, with that, let's get to our disclosures, and then we'll move into the discussion today. So first, remember that everything we cover today is for your information and your education. We do not make recommendations. We do not endorse any specific approach to trading the market here. We will be utilizing technical analysis, of course. As we do that, we remind you this is just one piece of your decision-making puzzle. We discourage you from making your trade decisions exclusively from technical analysis. It's important that you also know we are working in a paper money version of the thinkorswim desktop application, and that can have some challenges for us a little bit, in particular when we get into the scanning functionality in thinkorswim. And while I'm going to be speaking to the scanning in details, I'll try to remind you along the way that a lot of the study details that I like to use in scan are not going to be available to you in your paper money version. So you'll want to scan in live money and then take your lists, add them to your paper money, and do your pre-work and all your practice there. So keep that in mind. And now in this class, we anticipate, for the most part, maintaining an equity portfolio, but occasionally we might discuss the concepts approached with options. It's important to know, though, that those carry a higher level of risk, not appropriate or suitable for all of us as investors and traders, and you'll want to be familiar with the option disclosure statement prior to any option trades. Okay, so as I kicked off, I mentioned we're going to start with a broad market review, so we're going to jump right to that, everyone, taking a look at the S&P 500 at the close. And I think while we continue to maintain this upper level, it's pretty obvious we have struggled to get through that 7,000 ledge. And that 7,000 ledge is our current resistance. And for a lot of traders, I think what we're finding is that we've traded in this 200-point range essentially since late November. And so right about 6,800 or so, up to 7,000 or so. And really, from a new trend decision-making process, many traders are simply in sit on their hands mode here, everyone. Why is that? Well, sit on your hands because if you're looking to deploy new money, we're too close to resistance. In fact, I should probably designate that white line as a red line, which will at least kind of reiterate the resistance idea, right? And many traders would only feel comfortable starting a new position on a move above 7,000 on a closing basis, ideally above 7,228, of course, making a new high. And if we could do so with conviction, they'd certainly be encouraged. But we've been beaten back each time in the last month or so that we've tried to bust through it. And I also note that we have been dabbling with a bearish divergence for quite a while, everyone. Look at this. Each pop that we have had in the last, well, really, I mean, going back all the way, we've had a bearish divergence for one high, two high, a third high, a fourth high. So we've had 4 consecutive highs met with bearish divergence. And then now in the last month, we've continued to hit our head on that resistance level, and we've still made lower highs. So this does not present as an attractive view initially here for the bulls. It doesn't mean we can't get through that 7,000 level, but it does give bulls a reason for patience. So as it relates to the S&P, patience may be in the offing, and a retest of 6780, which is the low we just made, low of last week, that would be an interesting spot if retested and held. If retested and held, and giving, for example, a hold move like we got on this big candle, maybe traders are looking just to trade that 200-point range, and they can absolutely consider something like that. If we get down to 6780, 6800, get that bounce, maybe traders are going to come here back into it. So we'll take a look there and see what comes from here. But essentially, no reason to make a decision if you're looking to add new money to the S&P right here, because we are in this range, and the next move outside of the lines is going to tell us more likely the next directional trade we may consider. All right. So let's look at the NASDAQ 100. We know we've been under pressure in technology because certainly in every class that I've been either chatting or hosting, we've been covering this. And we can note that not only did we make a breakdown below the major moving averages, look at what we've done. We've bounced right back into the 20 and the 50 there. And I'm going to zoom in on this, and I'll highlight the fact that our bounce back has not yet carried us through those 2 big important moving averages. So let's see if we can get back above it. That would be a positive development for the NASDAQ. But a lot of traders are just talking about the fact that, that we made and we've seen this rotational move that has left the NASDAQ in a little bit of no man's land here because it is so heavily allocated to technology, as you know. And our leaders these days, this year-to-date basis, are not our growth companies that we're most familiar with, not technology, not discretionary. So our leadership's coming from elsewhere. We're going to look at that momentarily. So in order for the NASDAQ to be back in bullish trend here, we probably got to get above the confluence of the 20 and the 50-day moving average right above us at this point. So a little bit consolidation, kind of like this S&P, although the S&P, due to its allocation, is holding up a little bit better. Now, the small caps, on the other hand, continue to show us higher lows and higher highs. Now, we've most recently made a support test on the Russell at the 50-day moving average. And then on Friday of last week, we got a hold move, and it's carried us forward. We have now day 3 above the 20-day moving average, and we're going to see if that means that the 20-day is able to provide us some short-run support. Now, if we were to evaluate what had gone on before, we might look at it like this and say, boy, this was just a perfectly appropriate channel from the peak to support to test at the 50-day, which is kind of what the pullback was like when we made that prior high at 2,600 and we pulled back to the 50-day right here. And I'll take that little oval and I'll add it right to here as the reminder of our new support, or potential support, what traders might be basing current trend of the Russell on. So we'll monitor that 50-day moving average. If you're bullish, what we don't want to see is a move immediately or quickly back below the 20-day moving average. We'd obviously like to settle in, go a little sideways, and hold the 20-day to continue some upside. So there's been some merit here for the Russell to continue upward. Interestingly, today, yields fell quite dramatically, I believe tied directly to the consumer confidence number that came out today. And this fall in yields is certainly one of those tailwinds that the Russell could foresee going forward. So we'll see if that continues to play out and buoy small caps. In fact, when we get to doing our scan, we are going to scan the small cap group for a sector that we don't currently have exposure to. So with that in mind, let us look at our example portfolio. I'm going to jump over to my monitor page, and we can see that we've got 4 positions, a couple of which I think just one last week we put on. No, we put 2 on last week. We have our Schlumberger order and our One Oak order. Both of those got executed. We can see a purchase day 2-4, and then purchase day here 2-4. Okay. So we got put into both of those. But before we look at those, a couple quick things on this page for you all. I want to remind you that I have set this up to highlight the sectors that we have. I've done that by grouping symbols. So I've said, instead of none, which is what I traditionally would show when I just want to see all 4, if I want to ensure that I am allocating money to my various sectors, I think changing the group by to incorporate sector makes some sense. So you can see, last week we added 2 energy positions. We've been running a Caterpillar industrial trade, and we added Tyson Foods a couple weeks ago. Now, recently, we had tried a technology trade. It was on CRDO, Credo. If you want some humor, you can go back into the archive and see that we stepped into this trade completely inappropriately without our rules, and it led to us taking a loss. So a wonderful reminder that we are rules-based traders as best we can be, and that we need to adhere to our rules and our plans. The truth is here, we kind of entered into a bit of a revenge trade, so to speak. We tried to be a buyer on this beautiful candle day, and if we had been able to hold it, we would have been provided a nice weekly opportunity for profit taking, or at least elevating an exit strategy stop order, for example. But nonetheless, I was, let me think of the word, probably a little petulant about it, to be honest. I don't like missing trades where the opportunity was clear and I had the chance. So I went ahead and put us in at the high, and next thing I know, we've got a loss. So not just a loss that exceeded our tolerance, exceeded our comfort. It was a bad decision from the start. So we did get stopped out of that one last week, pretty close to the lows essentially, and now you've seen it rally back. Not necessarily a bullish chart at this point, being that we are back below still below the 50-day moving average, and you got a pretty red candle there today. Tried to open higher at the 50-day and finished pretty close to the 20-day. We may reevaluate this one later, but we're going to move back to where we actually have positions. Never, that's right, Connie. Yeah, if anything, take that from this lesson. Take that lesson, right? Don't revenge trade. It's not worth it. It rarely works. Okay, let's talk about Tyson. TSN, we've got a little bit of profit. Now, we have seen this one continue to move in our favor, and we are simply managing our trades. And what I want to remind you all is, as I have noted here in my scratch pad, I just added it today so that we have it noted, but stop orders are traditionally going to be placed 1 average true range beneath our preferred simple moving average. In the case of Tyson Foods, that is going to be the orange 20-day moving average. Now, we are well below the orange 20-day by down at 59.81, so we need to make an adjustment. Today, the orange 20-day comes in at 63.28, and let's go ahead and apply my average true range to the bottom of my chart. And I see that our ATR is $1.47. So from 63.28, $1.47 below it gives us a new stop at 61.81. Currently, our stop, if I hover over this, is at 59.81. That means we are approximately working to pick up an extra $2 in our exit strategy, which is wonderful. I have to remind you, even though we are going to raise this stop order up, there is no guarantee that we are going to be able to exit at or near our stop price. And that, of course, is because the stop, once triggered, becomes a market order. And it looks like I went a little too far as I pushed that up. So 61.85, I'm going to put that back to where it should be, 61.81. Because I'm trying to adhere to my rules, everybody. So we'll do that. 6181. There we go. All right, confirm and send. And there we are going to see a new stop order raised. So you could see it's elevated further. Yes, it's below the 20-day, but we have to move $1.81, or pardon me, $1.47 below the 20-day to get taken out in all likelihood. Remember that we do still have gap risk, so we could open, close, say tomorrow above 61.81, but opened the next day at 55. We would trigger right away at the open, and we would sell close to 55, not likely close to our stop at 61.81. So we do need to be aware of that gap risk. So working to mitigate the risk we have in Tyson. The chart is still bullish, kind of a bull flag happening up here, but essentially all it's doing, everybody, as I see it, is allowing this sharp move from 59 and change to 66. I mean, that is a 10% pop. Fantastic. It's just gone sideways for 2 weeks. It's just consolidating, allowing the 20-day moving average to catch up. So positive development for the moment. Hopefully we get the, now that we've got our elevated stop, let's hope we get continuation to the upside, and next week we can continue raising and elevating the stop. All right, next up is Caterpillar. Let's take a look. Caterpillar's doing great for us. We're up, let's see here. Pretty nice amount. I mean, 1,700, that's great. Let's see how we can work to manage this one. Caterpillar, we've got that stop well below us at 585 and change right now. And we, again, are going to manage our risk utilizing the 20-day moving average. Why are we using the 20-day on Caterpillar? Well, even though the 50-day has been our consistent moving average, meaning if I eliminate the 20 here, take a look. The 50-day at 622 is $122 away. All right, 122 from our 742 close. So my question to all of you is, would you be maybe more comfortable giving up the distance here to the 50-day moving average, which is 16%, or over that distance, right? 16% versus the 20, which is much less, of course. And so now that we are basically looking at 10% to the 20-day, that's a little bit more palatable. Obviously, we'd prefer not to get down to the 20-day, but we also are trying to maintain this position for as long as we possibly can. So our 20-day today, let's double check this to make sure. I think I got my numbers wrong on my pre-work, everybody. We are in 20-day is 666.70, and our ATR, going to add that back in here, is 23.34. So do a little bit of handy dandy calculator here with the 20-day moving average at 666.70 less the ATR of 23.34, and that puts us in a new stop at 643.36. Now that's a lot higher than where we are. Now I have to point out, we're doing this because things have changed a little bit. When we originally built it, yes, it was built working against the 50-day moving average, but being that we have seen in the last, basically year to date, it's just the 20-day now. And most recently, we've had that nice 10% pop. So we've moved up in the last 4 sessions from the intraday low here at 665 up to 752. So this thing has added 90 points in the last 4 sessions from its low to its high. So the 20-day has really extended versus the 50-day. Let us as traders try and capitalize as best we can to make sure that we don't give back as much profit as we could if we were to work with that slower 50-day moving average. So this is going to be a big adjustment, everybody, to push CAT up to from where we are. Okay, I'm going to move my dialogue there. All right, so we're in at 586.73, and we want to be about 23 points below the 20-day. Again, that's 643.36. So you saw me push the order up by clicking and dragging. We're going to right-click on it this time, cancel and replace, and I'm simply just going to put in the new number, 643.36. All right, stays good till canceled. Confirm and send, and there we go. Now we are right there. 23.5 points below the 20-day. Let's hope that that one continues to roll for us, though. The goal of this class is exactly what we're getting out of Caterpillar so far. We don't know when that trend is going to end. We do know eventually it will, but in the interim, we are just taking the steps to work to capitalize and protect profits that we have, and basically allowing the stock a little bit of wiggle room every step of the way, but not too much wiggle room, right? Just a little. All right, so there's your Caterpillar adjustment. Let's check on the other two, our most recent. Let's hit up Schlumberger. So we picked up Schlumberger. We've got a little bit of a profit, but probably not much to do here on Schlumberger. So we are looking at a $30 profit. Let's just quickly peek at it. All right, so we bought this last week on the Cahold move, which was this candle right here, because it broke the downtrend and the low day. These 2 days were our lows in the pullback, and this one finished above the high of both of them. So we took position based on that. Now we have a stop that is at 45.71, and again, it is an ATR beneath the 20-day moving average. So the 20-day moving average is 48.80. Go a dollar beneath that gives us about 47 and change, 47.30. We could raise the stop here, everybody. The question is whether we need to. Do we want to? We don't have to, all right? But a lot of you might be saying, boy, I don't understand. How could the stop already need to be raised in a stock that hasn't made any new highs since we bought it? I mean, it's made matching highs, right? It's gotten up a little bit, but ultimately we've just held the level that was recently achieved. So prices over the last 20 sessions, are all higher, and that's why that SMA, that speedy 20-day moving average, it continues to climb. So at 48.80 less our ATR, like I said, we could raise this up to about 47.25 or so, which according to where we are right now would be about $1.50 above. So I'd say, why not? We can do that. Let's go ahead. Let's raise it up about $1.50 to that 47.25 zone. And I'm just watching that bar along the right there to see the totals, and there it is. 47.24, even better, right off of the round figure of a nickel. We'll go ahead and adjust there. And let's see, I mean, again, we're never guaranteed that this is going to be the best exit, but what we are doing is giving ourselves something that is easily repeatable, which is really the key. I think a lot of you recognize that. Those of you that have been joining this class and the classes that I offer, we talk about needing to be easily repeatable and taking the step to reinforce that easily repeatable process. So taking advantage of our moves to the upside and raising our stops to reduce our risk, even though we can't make it entirely risk-free. All right, what about ONEOK before we move on and talk about new concepts, new trade opportunities, new potential examples, I should say. We've got ONEOK. We got into this one. Same thing, 5 sessions ago. We bought in on a test of the 20-day. So if I put in the order details, let's go ahead and hit that gear, and I say show my trades. You'll see we entered it the day following our Cahold. So we got the Cahold there on the 3rd. And then the following morning, we were able to pick that up. We got it at 78.89. Now, the 20-day here is 77.97. And we need to elevate that by a couple of bucks. So 77.97 versus where we are today and the stop, which is 71.76. So right now, we're giving up about $6 of downside risk. And we want to reduce that as quickly as we can because the stock has already moved in our favor. So according to the 20-day at 77.97, And then that ATR down below, $2.16, oops, tells us that we should be around 75.81. And again, we are well below this. So the stock has appreciated in price sufficiently for us to make this move. So we're going to kick this up to a ballpark of 75.81. And a lot of traders here, everybody, if you find these numbers, like I said, you might say, all right, I'm not quite where I want to be. 75.70 is a little beneath the number I was striving for. Cool, you can leave it there. Think about it, though, being below the mathematical calculation rather than above it, right? You want to, if you're going to give it a few pennies, make it a few pennies lower, okay? So you increase the likelihood of staying in the position rather than a few pennies higher, which increases the likelihood of you being stopped out. So we're going to go with that slightly higher elevation, so 75.70. We'll attempt to lock in some additional profits here, or if nothing else, reduce our risks to a much more palatable level. And so now every trade we are in, for the time being, is all better, has a tolerance for risk that is less than our $1,000 maximum, which is a really good spot to be in. Even in the instance that our trades work against us, if we've stepped into them with this max loss of $1,000, and then along the way our trades become profitable such that we can elevate our stop orders, well, then we're doing a pretty decent job, even if we're not capable of moving out at profits. Remember, yes, of course, our goal is to make money through the trading. That's absolutely accurate for a trader to say, but just as important is risk management and preservation of your capital, and that's why these planning processes are so important on a consistent basis. Now, let's move on to talk about MarketWatch. We're going to talk about the sector relationships. Where's our leadership? Year to date, it's the same ones as last week. Energy, materials, staples, industrials. We go back to the monitor page. Energy, industrials, staples, aha! One missing. We are missing our materials. So today we are going to scan in materials to locate some trade concepts and potential example trades. So we're going to go to the scan tool. We are going to incorporate the scan that I've built for this class specifically, which is very standard, and it's just uptrending all time frames. So I'm going to go load from my personal uptrending all time frames. And now, of course, these have average volume requirements. So a couple of key points in here. We are going to scan not in the S&P 500, but rather in the Russell 2000. Okay, so we're going to look towards the small caps for this purchase. We are going to further intersect with materials exclusively. So only materials, only small caps. Now, one other caveat we may wish to consider would be to incorporate a minimum price. And the reason I say that is that not everyone's comfortable owning stock regardless of price. And a lot of traders will suggest they want to trade stock only that are above $10 a share. And that's fine. As a reminder, in your small cap index, you're absolutely going to find many a security trading under $10. So adding this small adjustment can help to refine that list and make it a little bit more palatable for the trader who only wants stocks over 10. And I'm frequently asked, why 10? Well, commonly 10 is the threshold that institutional investors will incorporate with their own process. So $10 is a logical level to set as a floor. It's not going to be guaranteed towards anything, as you all know, but certainly a nice little additional variant to incorporate. So let's go ahead and hit this and see what we got, everyone. We'll scan for our results. And we've got 9. That's not bad. So I'm going to do what I like to do. We'll go ahead, save this one as a small cap materials so that I can access the watch list easily. So I'm going to do that up here. So I'm just going to give you guys some additional steps. We're going to save query, and I've got to move over here we are. So this is uptrending all time frames, and we're just going to designate here. Oops. small cap materials. Hit save, and now I can add in that watch list. And this way it makes it simple for me on my chart, as you all know. So here we'll go plus watch lists. And I'm going to speak this for you, everybody, so that I can take you through it. So watch list from down below, right? The plus sign, watch list. Then I go to the title, and I'm going to my personal. I've got all of those under uptrending. And I've got uptrending small cap materials. That's the one I just saved. So I'm going to click on that. And I'm also going to link it with my chart. So my chart is a 5 right there. Therefore, my watch list needs to be 5. And I've also got my watch list columns defined already. I'm going to get those in there as well. And so there is my list of 9. And let's just quickly look at a few of these. So let's see, CENX. All right. There is an uptrend holding a 20-day moving average. Vivian, I will absolutely share this scan with you. Thank you for asking. Let's go ahead and grab this. So now that I've saved it, it's really easy. So I'll just go and share scan query. Everybody, please remember, as always, scripts, whether they're scans or charts, grids, etc., these are not guaranteed for timing or accuracy. They're not a recommendation for your use, but you are welcome to incorporate them where you see fit. All right, so let's look at these, a few of these. I got a few to consider for our example trade, but I wanted to work through and just highlight all of these are going to be trading above all 3 major moving averages, the 20, the 50, and the 200. So we've seen elevation, right? Riding the 20-day. Many traders are comfortable buying at highs. Certainly think that highs are not bearish. That's one reminder. New highs are not bearish, but we can also look for our opportunities a little bit more in a disciplined fashion. And that would mean entrance will be more comfortable for the trader along the 20-day moving average. And so could we be buyers up here? Sure, but we'd have to sustain a $5 move to the downside plus our average true range to take us out of it if we wanted to use the 20-day as our support level, right? So maybe not CMC here just yet. What about CSTM? Similar situation. We could absolutely make a trade work there. ECVT, examples once more. All of these are going to be ones that could be working for an example. There's no doubt. There you go. See, this one's moved a little bit, maybe off of a level of short-term support in here. Nova Gold. Okay, so we're looking at a stock tied directly to gold and its price movement. So something for consideration. Mini trader will draw a line through these recent lows and try to indicate a little bit of a gentle upslope. It's kind of notable that we've been here before and it hasn't always held, right? We've kind of, in a couple of instances, been pushed back from it. We got this one little breakout and it didn't maintain. So maybe that one is I could certainly see an example trade here where the trader says, let's consider a buy stop. Maybe if you get the trade, the stock is through, some percentage above 1045, for example, and it's the final 5 minutes of the day, so that you have some confirmation that it's going to close above a certain level. You might consider a buy stop there as an example trade, but we're going to look today at a couple on the list that are at the top here. One of them is Coeur d'Alene, or CDE, Core Mining now, used to be Coeur d'Alene Mines. An interesting one because this is a stock that obviously rode to new short-term highs with the movement in gold and silver both. But what I found notable on this 1-year chart was the give back from the peak to the 50-day moving average that was then held. Yeah, we don't have an inspiring candle today. You were up through the day and finished right on the 20-day. Not wonderful per se. We're going to have to give this one a deeper level to test. So that's probably more like under the 50-day moving average down there, under 1976 by an amount of the average true range. But what stood out to me, I did a little Fibonacci move based on the low trade before the stock really got going in its rally. The low this day was just at 1355. Pardon me. Yeah, 1355 on this day. So I want to highlight 1355 or so. And I want to go to the peak. And as a reminder, when you're thinking about those Fibonacci's, if you can give back 50 and up to 61.8% of the upward move and hold, well, then traders that are bullish traders in this case, because we're looking at a bullish chart, they will suggest, hey, that's something that we could consider. The fact that it happens to coincide with the 50-day moving average is also kind of notable. And for short-termers, the very next day following the support test, we got a hold move. Okay, so that's a nice validation for the trader who wants to be a buyer at support. But if nothing else, we look at that 50-day moving average up sloping, and our exit has to be an ATR beneath it. So our ATR is $1.76, and that's 1976 is our 50-day. So that gives us an exit at 18. We'd have to come beneath that by a few pennies at least to get off that round figure of $18. All right. So a couple of things here. If we are exiting at 18 from an entrance that does not exceed $23, for example, which would be a little bit of a padded limit versus our close today, that means that we could own 100 and we would be risking about $500 total on the trade to our zone of potential support. Actually closer to 6. 23, no, I got that math right. 23 to 18 would be $5 total. So that's what we're going to consider as an initial entrance. And we're going to do it for essentially a half position, or excuse me, what is a quarter position, right? Because we're only going to buy 100 shares, max cost of $2,300 in this trade, but we are putting on risk of about $500, which is still within our tolerance. So I wanted to highlight that Fibonacci sequence as a reminder of a way that traders will validate a support test from time to time. Now, our entrance, as I mentioned, is going to be with a custom order, and we're going to use a stop, not a target above us, but a buy limit not to exceed $23 for tomorrow's business, but our stop thereafter will have to be good till canceled, 18, and I'm going to come beneath that, like I said, a few cents. Go back to my graduation year, 94, good year. Okay, so anything better than $23 or lower, and our exit thereafter would be at 17.94 stop, which becomes a market order once triggered. No guarantee that our execution would be at or near our 17.94, but that's what we're going to strive for on CDE for tomorrow, and we'll see if that continues or if this just continues the uptrend that we've seen. It's been volatile most recently, but if this is going to get going again, well, we've got a little bit of wiggle room here. We could even get another 50-day support test and still maintain the position. So that's what we're striving for with that trade. Now, the other one we're going to look at is Cabot, CBT. And the reason we're going to look at this one, everybody, is this recent move above the 200-day moving average. So we've been below it since December of 24, and we didn't get above it until January of 26. So basically a 13-plus month downtrend that may have now been corrected. So let's take a zoom and notice how, if I pull that, notice how today's tail is on that same level. Look at this. You had peaks acting as resistance. Resistance, once broken, can become support. And so what did we do? It's exactly what we did. Broke through. Now, granted, what was it? It looks like it was earnings. Yep. Earnings pushed, retreat, hold the breakout. Now we can talk about a potential new uptrend. Today, not quite the hold move we're looking for, but we could work against the 20-day because we've essentially been holding the 20-day all the way back to November of last year. So again, here, we don't want to go too heavy. Okay, 100 shares would be sustainable for a 10,000 share position at 7,300, right? We could manage it. But let's go with more likely a 50 share position, and I'll run my risk under the 20-day by the amount of the ATR. So where is the 20-day? Let's go ahead and do our math on this, everyone. 20-day, 72.97. Okay, And our ATR is $2.72. 70 and a quarter is our exit strategy. And our entrance is going to give it a little bit of wiggle room up to 76. Let's give it 50 cents, everybody. Let's say 76 and a quarter to make this purchase. All right. So right click, buy custom with stop. We are willing to go up to tomorrow, 76.25. And once more, even though that's our limit, if the order is up and the ask is under 76.25, we will get the lower price. Okay. Again, our exit here needs to be good till canceled. We have it at 70 and a quarter, but I'm going to go beneath that by about 7-8 cents. So let's say $70.17, which will increase our chance of maintaining the position. All right, let's check that out. So our total investment, oh, I put it in for 100. Let me edit that. I wanted to do that for 50. So let's make sure we do. There we go. Buying 50, selling 50. Okay. We can add to this, by the way. Remind me, those of you that I'm certain will be back with me next week, remind me if we get a push to new highs and we trade through the high we made following earnings, many traders would look at that as a continuation move. If we get a close over and a new high, they would look at that and say, that's our opportunity. We should add and make it a full position, or add to make it from maybe a half a position to a full position, something like that. Okay, so we'll look at this one again come next Tuesday. All right, so there you have it, everybody. We've done a brief market overview. We've done an example portfolio review. We elevated the stop orders for 3 of our 4 positions, and we have taken it, working to take advantage of the upward trajectory in the positions we've established. And further, the big takeaway I want to give today is the reasoning we selected what we did. We did our broad market review. We know that there's some leadership from small caps. Further, we have 4 leadership sectors, one of which we have not yet previously had exposure to, which is why we've selected materials today. Okay, so we scoured and scanned, searched that group, located stocks trending 20-day, 50-day, 200-day, and then we got to look at all of them and picked the ones that were most interesting or most exciting for us. Remember, we don't have to trade every single one of those example opportunities. We just need to find the one that makes it easy and easily repeatable for us, right? Don't make this harder than it has to be. It can be simple if we allow it to be. So with that, big thanks to you, Connie, for being here. Appreciate you, and certainly appreciate you reminding me revenge trading just doesn't work. We know better than that. Follow Connie and me on X, Connie Hill, CS, Kevin Horner, CS. Hit that thumbs up button for me down below. I'd always appreciate that. That'll help me out in the YouTube algorithm as we get this reviewed and archived for you. And make sure you're subscribed to the YouTube channel, of course. Last thing, I'm going to be in San Diego at the end of this month for our market drive. If you are there, make sure you stop by, say hi, shake my hand. Let's have a conversation. I love seeing you all when you come out to the live event. So as always, appreciate you being here. Have a fantastic rest of your Tuesday afternoon, everybody. I look forward to catching up with you again real soon.